So some students have not studied finance or accounting before, right? So for that reason we need to study some background before we get into the course, right? So the first thing we're going to look at is financial statements. So the financial statements we're going to talk about is balance sheet, income statement, we already learned some vocabulary about them, cash flow, and then we're going to look at some equations. Then we'll look at some example on the internet of the real companies, balance sheet and income statement. So the first question we have to ask is, how valuable are the assets of a firm? So how much are my company's assets worth? Okay? So we split them into different sections. Those that have long lives, like land and buildings. Those that have short lives, like inventory and cash. And also assets which are not tangible or physical. So patents and trademarks. This is called intangible assets. So the second question is, where did the company get the money to pay for the assets? Did we get the money from the owners, called equity? Or did we get the money, borrow the money from the bank? Or maybe from, by bonds, by selling bonds? So as we said, the mix of equity and debt can change as the life of the company changes. This is called leverage. How much debt do we have? How much equity do we have? So the balance sheet has assets here and liabilities here. So this side is equals to this side. Does the balance sheet show profit and loss? Does the balance sheet show profit? No, it doesn't, right? The asset sheet is not showing the balance sheet is not showing profit. The balance sheet is showing what assets do I have? How much are they worth? What liabilities do I have? How much are they worth? Right? So my assets always match my liabilities. Equity is included here, right? So these two should match. This is equals to this. So we have this sections: fixed assets like buildings, current assets, financial investments. If we invest in bonds of another company, this is also an asset. And intangible assets. We can see on the other side, the liabilities. Equity is included here. Equity is the money of the owners. Okay, the funds of the owners is equity. So if it's public, it's the stock, value of the stock. So let's talk about the income statement. The income statement is going to show us about profit. Okay? So the income statement shows us how profitable are the assets. It answers this question. Is the profit greater than the risk? Right? So we have to estimate our profits. We have to know what our profits are every year, or estimate what our profits are going to be every year. We use the income statement to do that. The income statement looks at the money coming in and the money going out. Okay? So here we have an example of an income statement. Revenue, money coming in. Sales, right? Income from interest. Total revenues. Costs and expenses. Do you understand expenses or cost? Expenses is money going out. What kind of expenses do you have as students? Fees. What else? Soju? For students, would soju be listed here? No? Books, right? Books, pens, okay, that kind of thing. What about your revenue? Where's your revenue? part-time jobs, something like that, right? So do you do your own income statement? No, you should. Right, you should keep account, generally anyway, of the money you have going in and going out, so you know, right? So, anyway, for a company, mainly the revenue is we sell the goods or the cans of Coke, we get the money, right? Then we have the costs, salaries, we have to pay the salaries of our workers, supplies, repairs or maintenance, utility is electricity and so on, right? Insurance, rent, okay, advertising. So we notice here, we'll talk about later, depreciation can also be included on the income statement. So we add up our revenues and we add up our costs, okay? We subtract them and we get our net income. Our costs are higher than our sales. Could be a problem, right? Maybe not in the first year, but later. So we're going to talk about accounting and the accounting view. So this is like accountancy, right? Where accountancy is Wege, is that correct in Korean? So the main point of these two accounts, what are the company's assets and liabilities, right? Is the company making a profit? Of course, if the company is public and selling stock, they need to show this to the public so people can see the company is making a profit or not making a profit, right? So say that in the first quarter of 2015, Coca-Cola says that my profit is very low. They release their income statement and we can see that Coca-Cola's profit is very low. Do you think the stock price will go up or down in Coca-Cola? Right, maybe the stock price will go down. So companies have to make these kind of accounts or financial statements so people can see what's happening in the company. So when we think about accounting and how much is our asset worth, we have a couple of choices. We can say it's the market value or it's the historical value. So if I give an example for this, if I own an apartment, for example, how much is my apartment worth? Is it easy to say? Unless I sell my apartment? It's hard to know, right? We can look at the market value, maybe an apartment very similar to my apartment, next to my apartment, was sold last week. That's the market value, right? Or we can look at the historical value. How much did I pay for my apartment? So generally, accountants prefer to use the historical value than the market value. Okay? Which one do you think is more accurate? Market value or accounting value? Or sorry, historical value. I think the market one might be more accurate, right? But accountants like to underestimate. If there's two values, accountants like to take the lower one than the higher one, usually, right? So they usually use the historical value instead of the market value. Also, the market can change quite quickly. The market can change. So accountants don't trust the market value that much. They prefer to use the historical values. Okay? So the historical cost is the original cost of the asset. How much did I pay for the apartment? Okay? Then this is the value of the apartment, according to the accountant. Not the market value that maybe I could sell it for today. Okay. Did I make some improvements to my apartment? Yes, I did the interior. So we can make the value higher. Okay? And if we're not talking about an apartment, we're talking about a car, then the car got older, maybe the price has to go down, right? So they call this the book value. So we have book value against market value. So accountants prefer book value. they have a belief in book value they think is the best one. They don't really trust the market value or the estimated value. And as I mentioned, they prefer to underestimate. Do you understand underestimate? If a girl asks you how old I am, how old am I, should you underestimate or overestimate her age? Underestimate, right? So if you ask me how old you are, then I have to say 19, right? I'm not going to say 45. Right? So accountants like to do the same thing. They like to underestimate, take the lower value rather than the higher one, right? Just to be on the safe side. So let's finish there for today. So you can find the link for the book we're using on the website, right? And also the link for the PowerPoint presentations on the website. And I'll put up just this short video, okay? So then see you next week. Have a nice weekend.